Joining us right now is the head of institutional equity strategy at Stifel, Barry Bannister. Barry, it's good to see you this morning. Thanks so much for being here.
Thank you.
So your expectations for the third quarter earnings reporting season, and when you look at the banks today, this is obviously a heavy day on banks. What would you recommend there in terms of allocating capital?
Yeah, we actually look at the bank earnings on a large cap basis, particularly important right now. So we'll be looking at net interest income, what they're seeing on the trading front, and also we would expect the 10-year yield to begin to move a little higher, which tends to benefit banks overall. As a consequence, they're very important to the cyclical side of the economy. And we've been dominated, as you know, for a year by the defensive side, the utilities, real estate investment trusts, and consumer staples. But we actually think there's a rotation back for a few months, at least, into cyclical stocks like financials.
So the cyclicals, of course, would be sort of dictated by the broad economic backdrop, the cyclicality of that. Do you think that we are seeing a better backdrop, or are you worried about a slowdown causing a recession?
No, I certainly always watch for the recession risk, and that's been the big worry. But think where we were a year ago. The Federal Reserve was talking about autopilot tightening of the quantitative tightening of the balance sheet, shrinking its assets. Chairman Powell was talking about being a long way from neutral, meaning rates would keep going up. And we completely reversed that. We've had 2 rate cuts, possibly a third. I think that would be it, though. And we've also seen the Fed move to replenish bank excess reserves, or liquidity. So this is all very bullish. I also like what I'm seeing slowly on the trade front, and I think that the Brexit news is net positive. So we got ourselves all worked up in the last year, and I think it's time for a little bit of a snapback for risk.
Yeah, and you heard St. Louis Federal Reserve President James Bullard threatening insurance rate cuts. Bullard says that such cuts would, quote, help recenter inflation to help the economy stay on track out of a possible recession. Bullard was also supporting the Fed's last 2 interest rate cuts and said that any future rate decisions would be made on a meeting-to-meeting basis. So I guess it's just, dictated by the activity out there. Jack.
Sure. A question for you. I'm Jack Otter from Barron's. We've been fairly bullish on the banks just because of their cheap valuations. But you could also make a case that, frankly, they deserve those cheap valuations. Do you see multiples, price-earnings ratios moving at all higher, or is it just slogging through trying to gain a little bit more margin on net interests?
I would say that the price-to-earnings ratio right now is maxed out. If you look at where we are at about a 0 to 0.25% real Fed funds rate, that's Fed funds minus the core PCE deflator inflation. 19 times trailing operating using S&P earnings estimates is about all you'd expect at this point. I'm not really looking for a huge market move. What I've been talking about the last week, and particularly this note that we did Monday, was a rotation more back towards a cyclical risk profile within sectors. Again, we have really seen a outperformance the past year and year to date in those defensive utilities, real estate, and staples. It looks like now we've got a yield on the S&P that's above the 10-year yield. It does seem to us that there's a little bit of a year-end rally coming up, and particularly a rotation back into cyclical risk.
So you want to go back to growth?
Well, no, growth stocks would be a sort of a different animal. I was talking more about the cyclical financials, energy, perhaps a little bit of industrials and basic materials as particular beneficiaries of that. Again, the sentiment got very negative, and it was time for a rotation back to positive.
Barry, really quickly, Deirdre here. So I heard you say financials, and there have been a lot of people recommending them for a long time, and it hasn't paid off. We're in a low-rate environment. What's different this time?
Well, again, the Fed is adding an enormous amount of liquidity to the system, according to what we're seeing. I mean, it depends on whether Treasury accommodates them by increasing the auctions of shorter-term paper when they announce their auction schedules at the end of this month. But as they add the reserves to the system, it does add liquidity, which was a concern. You saw what happened in repo recently. The other thing is we do think that the 10-year yield pops a little bit higher, and that tends to correlate with the financials' relative strength to the S&P 500 index. So when I look at it, we've not been positive on financials. We have been big bulls on defensive utilities, REITs, staples for the past year. But it seems like a little bit of a reversal back on that is on the table right now.
All right, we'll leave it there. Barry, we'll be watching. Great to have you. Thanks so much.
Thanks.
Barry Bannister joining us there.